Assalamu alaikum. Welcome to lecture 13 of ATX. Lecture 13, lecture 14, and lecture 15 will be introducing you to a new tax, which is inheritance tax. So I've finished two types of taxes, income tax and capital gain tax. They're over. Now you will be introduced to the third type of tax, inheritance tax. So this and the remaining two lectures 13, 14, 15 will be on your inheritance tax. Here we are going to focus on how inheritance tax charge is calculated, what are the occasions of charge, lifetime gifts, exemptions and reliefs, how we have exemptions and reliefs for CGT, and income tax we have for inheritance tax also. In fact, for all the type of taxes, we have some exemptions, some reliefs. Exemptions available for lifetime gifts, exemptions available for lifetime transfer and death estate. IST payable, IST is inheritance tax, payable during an individual's lifetime on CLT. CLT is chargeable lifetime transfer. IST payable on lifetime gifts as a result of death, fall in value relief, which is new for ATX. IST payable on death estate and summary. Now, so under inheritance, you're going to go through the framework of IST and occasions of charge. IST is based on transfer of value. See, when your value falls down, what is the meaning of inheritance? First of all, inheritance means when you gift an asset or a property to another person. It could be your son, your spouse, your siblings, or another third person, anyone. When a property is transferred from one person to another person, we say inherit, right? Suppose my father's properties will be inherited by me. That's why the word inheritance tax comes. So when we inherit a property or a gift from another individual, we have to pay a tax on that. That's why it's known as inheritance tax. So when there's a transfer of value. Okay. So your inheritance tax charge is based on that transfer of value. How much the value is falling. Next, chargeable property and chargeable person. Now, lifetime gifts. If it's a lifetime gift, it will be chargeable to inheritance. Some gifts during lifetime are exempt gift. We'll go through the list. PAT, potentially partially exempt transfer. Up to a certain period of time, they are exempt. After that, they'll be chargeable due to the death of the donor within the 7 years. If they die and they have given you a gift within 7 years, if they die, whatever was exempt now will be chargeable. And CLT, chargeable lifetime transfer, forever is chargeable. Then we have death state. There are two things. One is during lifetime and one is a death state. Death state is the later one which we are going to go through. First, we'll finish the lifetime gifts. Okay. When the donor dies, what would be the property value of him? That is known as death state. Now, so this and the following two lectures deals how individual will be liable to inheritance tax. This lecture is about the principles that underpin IST and calculation of IST on lifetime and death state. Lifetime gifts. Remember, lifetime gifts often comes in ATX exam. Okay. And lifetime gifts has two important taxes that they will ask. One from the point of capital gain tax, the other one from inheritance tax. You have to be prepared for both. CST I've covered. Now IST I'm going to cover. So after IST lectures that I'll be covering, you should be very clear what would be the impact of a lifetime gift, both CGT and IST implications you should be knowing. It will be tested. It is not just one tax that they will test, multiple taxes they will ask in ATX. Okay. Why? Because when we are giving a property, it's a capital transaction. Okay, so capital transaction will have an impact on CST as well as IST also. Okay, and this is very frequently asked. Now, charge to IST. So IST will be charged on transfer of value on a chargeable property by a chargeable person, and it arises on death of an individual on the state value, on lifetime gifts when the donor dies within 7 years of the date of the gift, and on lifetime gifts which are taxed at the date of gift. Three things you have to remember: death state, lifetime gifts when donor dies within 7 years, and lifetime gifts when it is gifted. Now, transfer of value, diminution in value. So when you are gifting an asset, it results in the reduction of the value of the donor's state. From donor's state, value is reducing and it is going to the donee who is going to receive the asset. Okay, so this transfer of value will be treated as what? Gracious disposition, means a gift. A bad business deal will therefore not be liable to IST. That means your value of an asset falls down because of some bad business deal, then it will not be chargeable to IST. It should be a gift. For the value of an asset to fall down, it has to be a gift, then only IST will be chargeable. Okay, sometimes value of the state could fall for many reasons. Maybe because you were not gifting, maybe it was, why? Because it was not the donor's intention to give anything away. That's why it will not be chargeable to IST. Now, to calculate transfer of value, we see what is the loss to the donor. So the loss to the donor is the difference between the value of the donor state before and after the gift. This is your starting point for IST. Value of state before gift, value of state after gift, difference is diminution in value or transfer of value. On this we'll charge IST. So the loss to the donor is the open market value of the asset gifted. Now, in some circumstances, transfer of value from the donor's point of view is not the same as the value of the asset received from the donor's point of view. There could be differences. This is very common with unquoted shares. Why? Where a controlling shareholding might have a higher value per share than a minority shareholding. In addition, special valuation rules apply to gifts of certain assets. These rules will be covered in lecture 15. We are still in lecture 13. So now let us do a question on this diminution in value. Test your understanding 1. You have to calculate transfer of value relating to gift of unquoted shares for IST purpose. So you have been given the holding up to 25, 26 to 50, 51 to 74, 75% or more, and value per share 9, 15, 26, 45. Now, Shira owns 6,000 shares, represents 60% holding. She gifted 20% to her friend Yusuf. Okay, so now we'll see. So 60%, okay, 60% holding falls within this, and value of the state after transfers. She gifted 20 means from 60, if 20 goes, 40 remains. So it will be here. This is the value because 26 to 50%, that is 40% holding. This would be the value. Okay, 6,000 shares she has, which represents 60. So after the gift, she would be having 4,000 because 2,000 she have gifted. So it would be value of state before transfer, value of state after transfer. 6,000 and this is 4,000 into 26 and this one is into 50. That's how we get the price. 156,000, 60,000. It is 96,000. This is the transfer of value. Now, what's next? That's it. So now let us go to the next part. So next, from diminution in value, we are moving towards chargeable property. All property to which a person is beneficially entitled is a chargeable property, and it will form a part of person's state. Therefore, a gift of any asset to which a person is beneficially entitled is known as is a transfer of value unless it is an excluded property. Excluded property will not be chargeable to IST and includes this. Remember, you should know what are the excluded property, because in your ATX exam they might give you the list of property. In that list they might give you excluded property also. Mistakenly some students might include that in the property state value, right? You should not do this. So property that is situated overseas where owner is not UK domiciled, don't include. Reversionary interest in trust fund, do not include. By the way, trust is the next topic that we are going to finish after we finish the whole of inheritance step. Next, chargeable. So these are the only two excluded property. Then we have chargeable person. A chargeable person includes individuals and trustees of certain trust. However, examination question will focus on individuals only. So do not worry about the trust part. Then all individuals are liable to inheritance on their transfer of value. All individual who is domiciled in UK is liable to inheritance on the transfer of worldwide assets. If not UK domicile, then only transfers of UK asset is chargeable. Spouses are chargeable to inheritance separately. Now, next is occasions of charge. Okay. So the main charge to inheritance arise when an individual die as they become liable to inherit, liable to the following. The value of all of their net asset in their estate at the date of death. They'll become chargeable. Any lifetime gifts made in the 7 year before their death, provided they are not exempt gift, will be chargeable now. Becomes chargeable now. That means they have made a gift during when they were alive, and within 7 years of making that gift they die. Within 7 years. So that means for you to be excluded from IST, you should stay alive for at least 7 years. More than 7 years, if you die after 7 years of the date of gift, it will not be chargeable on you. However, certain lifetime gifts are always chargeable to IST when gifts are made. Next is lifetime gifts. There are three types of lifetime gifts. First one, exempt, no IST. Next, potentially exempt transfer. This becomes chargeable if the donor dies within 7 years of the date of gift. Next, CLT, chargeable lifetime transfer. Taxed immediately and also on death. Okay, so these are the three. Now, and also PET. Okay. Now, these are the types of lifetime gifts. Now, this table will help you a lot in the revision of your life inheritance tax. That's why I prepared this table specially for you. Now, a gift that is exempt from IST. A gift, PET, by an individual to another individual, by an individual into a disabled trust, and chargeable lifetime, no definition. It is the residual category. Residual means a gift which is not exempt, a gift which is not PAT also. It is CLT. These are the main example. Gifts into trust are always chargeable. Except if it's a charitable trust. Then it is treated as PET. Now, during lifetime, no IST payable. Okay. For exempt transfers, no IST payable. No IST payable for PET during lifetime. But on CLT, IST will be payable. If donor lives 7 years, no IST, no IST, gift becomes exempt. But CLT, no further IST payable. And if donor dies within 7 years, no IST because it is exempt. For PET, it becomes chargeable. The first time the donor dies, the PET becomes chargeable. And there will be an extra charge. If donor dies within 7 years, extra IST payable will be there using the death rate of tax. Now, lifetime gifts. Okay, these are the lifetime gifts that could be made: exempt transfer or PET or CLT. Now, for ATX exam, all gifts into trust are CLT. Other than that, trust for a charity, okay, if it's a trust for a charity, then it is exempt. Or if it's for a disabled person, it is a pet. Remember, there's two type of trust: charity and for disabled person. They are not CLT. Other than that, all trust. If in your ATX exam they don't mention that this trust is for charity, this trust is for disabled person, then assume it is CLT. PET. This derive their name from the fact that if the owner lives more than 7 years after making the gift, transfer is exempt. Okay. However, if the donor dies within 7 years, then it becomes chargeable. That's why it has a chance of being exempt also. It has the chance, potential of being taxed also. That's why the word potentially exempt transfer. It is not correct. Exempt totally, because we have to wait for 7 years. We have to wait for the date of death of the donor. But it might become exempt. Potentially. Potential is there. Transfers on death. Remember, transfers on death can never be PET. It is only the transfers on life, transfers during lifetime. Okay. Now, these are some exemptions and reliefs for IST. We have different exemptions and reliefs for lifetime gifts, for lifetime and death state, and for death state only. Let's go through. Small gift exemption. Looking at the word, we'll go in detail to each of this. But briefly, looking at the word itself, you can make out that small gift exemption means a gift of maybe a small value. Okay, exempt. So the max is 250 per recipient per tax year. For one tax year, for one recipient, it's 250. Marriage exemption. 5,000 if a gift is made during a marriage by a parent, up to 5,000 exempt. Then 2,500 by the grandparent and 1,000 other people. Now, normal expenditure out of income. Annual exemption. Now, your annual exemption is very important. This often comes, okay? This often you have to deduct, like how we deduct personal allowance from income tax, annual exempt amount from CGT. Now, annual exemption, AE for IST. 3,000 per tax year, can carry forward unused amount 1 year. That's why we always write 6,000 for annual exemption amount. 3,000 of the current year, 3,000 brought forward from the previous year. And fall in value relief. So how many are there? 5 lifetime gifts. There are 5 exemptions, 5 reliefs. Coming to lifetime and death state. Inter-spouse exemption. Anything between spouse, gifting to spouse is exempt. Charity exemption. Political party exemption. Agricultural property relief. Wherever the word relief is there, remember it is not exemption. Some kind of relief is there. Maybe some amount you can reduce. Business property relief. See, business property relief and in CGT business asset disposal relief are separate, okay? Next, death state. These are only for death state. Quick succession relief. Succession means when another person comes in your place. You die, you are the predecessor, and the successor comes. So quick succession relief, QSR. Double taxation relief. Residence nil rate band. This is on your residence. Okay. This list is very helpful. Coming to small gift exemption. One by one we'll go through now. Lifetime gifts. Lifetime gifts are exempt if they are and gift no more than 250 per recipient per tax year. Anything in excess of 250, what happens? Taxable. Then small gift exemption will not apply. Let's say you are giving a gift of 300. What happens? It will not qualify. Remember, see, you might make a gift of 240 to a person, and to the same person you are making a gift of another 100. Because you might say that 240 is less than 250, 100 is also less than 250. So two times you are making. You are making it in two separate installments, 240 and then 100. Remember, neither 240 neither 100 will qualify for the small gift exemption. Why? Neither gift will be exempt. Why? Because to the same person, if you add up the 240 and 100, even if it's less than 250 individually, together it's 340, and you are making it to the same person. If it was two separate people, 240 is to one person and 100 is to another person, then it would be exempted. Both are exempted. But if 240 and 100 are to the same people, same person, neither 240 neither 100 gift will be exempt. Both are chargeable because you are making it to the same person. And 240 and 100 if you add is 340, which is more than 250. You can't make to one single person more than 250 in one single tax year. However, donor can make gifts of up to 250 to any number of recipients. There is no limit to a number of recipients. It could be 10 recipients, 20 recipients, 30 recipients. All will be exempt. Marriage exemption up to the maximum limit. 5,000 by parent, 2,500 by grandparent, 2,500 by party. That means from groom to the bride or bride to the groom. And 1,000 by anyone else. Remember, this exemption is conditional on the marriage taking place. There should be a marriage. If you are not married, exemption will not apply. Normal expenditure out of income. Okay. If a gift is made as a part of the normal person's normal expenditure out of the income, and it does not affect their standard of living, donor's standard of living, then it will be treated normal gift. Okay. That means there's a, if you see there's a regular pattern of giving. For example, a grandparent is contributing towards the payment of school fees for his grandchild. Okay, or annual payments into a life assurance policy for the benefit of a child. Then these are exempt. Okay, they will be exempt. Why? Because it's a regular pattern of giving and it does not affect the donor standard of living. It is from their normal expenditure. It's like a normal expenditure out of their income that they are giving. Then it is exempt. Annual exemption. Very important. This is an exemption which always comes, which is often deducted. So this first 3,000 of lifetime in any one tax year, and it is applied chronologically to the first gift in the tax year. You might be giving multiple gifts in a tax year. In a one tax year, you might be having 5 gifts. But when we are giving this 3,000, it should be given again the first gift made in the tax year, chronological order, and then second, and so on. And must be applied to the first gift, even if the first gift is a PET, potentially exempt transfer. Still, 3,000 will go against that. Because we know PET might never become chargeable. Might. But still, annual exemption amount needs to be reduced. Now, any unused AE, annual exempt amount, can be carried forward to the next year. However, it can only be carried forward 1 year. Can only be used after the current year. First current year, then the brought forward of the last year. Other exemptions or reliefs, if available, are given before the annual exempt amount. Remember, if you are having other exemptions or reliefs, take them, consider them before annual exempt amount. Annual exempt amount is the last to consider. Note that annual exempt is used up by the potentially exempt transfer as well as the CLT. Both can use this, where more than one transfer is to be made during a tax year. CLT should be made before the PET to ensure that we are making the optimum use of AEY. See, CLT we know are chargeable. So, definitely it is chargeable. So, it's better to use AE against that rather than PET. PET might be later exempt also. Right? It is tax planning. Now, let us do a question. Test your understanding too. There are 5 lifetime gifts made by Janet, and we have to calculate the transfer of value after the AE, annual exempt of each of the gift. First, so if you see, it follows an order. So you have to start with A, B, C, D, and E. Okay. Now, 600 to her son, 800 to discretionary trust, 2,100 to an IEP trust, 1,100 to discretionary trust, and 5,000 to her daughter. So if you see 600 to her son, okay, so this is the solution. First, you have to mention next to it whether it's PET or CLT, because it is to a son and the dates are very important. This is A, B, C, D, and E. Because it is to a son, it is PET. You see here, it's PET. Discretionary trust, CLT. IEP, CLT. Discretionary trust again, CLT. And to a daughter, PET. Tax year is given. Tax year is very important. You should always write the tax year. So this is 1920, 1920, 2021, 2021, and 2122. What are the transfer of value? Just write the figure down: 600, 800, 2100, 1100, 5000. Annual exempt amount. Okay, they have to reduce. So do we get any other exemption? We don't get the small gift because nothing is less than 250. Marriage allowance, they haven't mentioned anything with spouse. Okay. So now just deduct the annual exempt amount. It is 3000. But in this year, you can only reduce up to 600 for 1920, 2019-20 current year, and from the previous year, this is still you can use it, but it is lost because we haven't used this year. This 3000 you can't carry it forward to this year. Next, you can't. Sorry, this year 2021, it's lost. So all lost as not used and can only carry forward for 1 year. So out of this 3000 of the current year, you have used 600. So you can use another 2400. Okay. Again, you have used 800. Out of 2400, you have used 800. They are in the same tax year. And here also nothing to be used. You can't use. And now we are coming here. So 2100, you can use the current year's 2100. And whatever you have not utilized is lost. Then this year, you are still in the same tax year. This is same tax year, 2021. You see, out of 3000, you have used 2100 this year and this year. So remaining 900 you can use from this. Out of this 900, how much is remaining? 200. That 200 could be from the carried forward balance, previous years carried forward. Okay, because you might be having 3000. And you still have some left, 200. Then from here, 5000. We straight away use 3000. It's more than 3000. And you can't use any of the not forward balance. So in all the chargeable amount is 0 except this here. Okay, this is very easy. It's not at all difficult. Next are exemptions for lifetime transfer and death state. The second category, the second column in that table. First column we have finished. The 5 reliefs and exemption. Inter-spouse exemption. So any transfer between spouse are exempt, whether they are made during the individual's lifetime or on death. There is no maximum limit to this exemption unless transferor is UK domicile and transferee is non-UK domicile. Then the maximum exemption limit is up to 325,000. 325,000 is, by the way, also the current nil rate band. Then, however, an election is available where a non-UK domicile with a UK domicile spouse can elect to be treated as a domicile in UK for inheritance tax purpose. This is beneficial if it's done. It's beneficial where assets are more than 325,000 because then there are no limit to the exemption. Okay. For example, you are having an asset more than 325 which are transferred to non-UK domicile. Then that time this election is beneficial. Then your whole amount, whatever amount more than 325 will be exempted. But if one spouse is UK domicile, the other one is non-UK domicile, then this transfer is made, means a value more than 325, then your limit is only up to 325. Okay, so you have to see the condition. Next exemption is political party exemption. So gifts to qualifying political parties are exempt. Same whether they are made during the lifetime or death. There is no maximum limit to this exemption. Okay. So a donation to a political party qualifies for exemption if at the last general election preceding the transfer of value, either the following conditions are met. 2 members were elected to House of Commons or 1 member was elected and at least 150 votes were cast by the party. This usually is not so much asked in ATX, right? This exemption. But anyway, be prepared for it. Charity exemption. Yes, this comes. So gifts to any recognized UK charities are exempt, whether they are made during lifetime or on death. No maximum limit. In addition, there is a reduced death rate of inheritance tax for states in which at least 10% of the taxable state is left to charity. Let's say your state is taxable and it is left to charity at the end. Okay? Some portion of taxable state is left to charity. Then whatever your inheritance tax, death rate for inheritance tax will be reduced by 10%. This working is required when we are calculating death's death. This is very important. That time we'll repeat this again. For time being, keep it. Now, gifts for the public benefit. Let's say gifts to any non-profit making organizations are exempt. Examples like land and buildings of outstanding beauty. Undertakings are required concerning the use, preservation and public access of property. Gifts to a number of national institutions are also exempt. For example, British Museum, National Gallery, Approved Museum, Library, Art Gallery and National Trust. Now, let us do a question. Test your understanding 3. Ramona made the following lifetime transfer. So calculate the transfer of value after exemptions for each of the gift. Unquoted shares worth 525 in a family company to her husband. 15,000 to son as a wedding present. 20,000 to nephew. 235 to friend. 270 in trust. 90 in a registered charity. And 20 to the Labour Party. Okay. So out of this, there are some which are exempt. First, let us understand the exempt gift. Okay. Coming to the unquoted shares. Okay. First one. This one. It is to a husband. This is exempt. Why? Interspouse. ISE. Interspouse exemption. Wife to husband. That's why it is exempt. Second, 15,000 to her son. As a wedding present. Up to some amount. Marriage exemption is there. But it's up to some amount. Okay. It is by a parent to a son. So how much? 5,000. 5,000 is the marriage exemption. But it is not totally exempt. Then 20,000 to her nephew. 20,000 to her nephew. This is also PET, not exempt. This one is also PET. Next, 235 to her friend. This 235 to her friend is less than 250. Small gift exemption. Small gift exemption. So it's exempted. Next, 270 discretionary trust. Chargeable lifetime transfer. It is not exempt. Then, to registered charity. Exempt. Why? Because it is to a charity. Next, this is also exempt. Why? To a political party. So total how many are there which are taxable? This 15,000 to a son, this 20,000 to nephew, and this 270 to discretionary trust. Only this three. So now let us do a table for it. First one is PET to son. You often have to write a column like this. You don't have to make a column. You can do this in Excel. Second one is also PET and CLT. The dates. So this one was 6 July 2320. So the tax year is 23. It should follow a chronological order, by the way. Okay. Next, to nephew, 27 September 23. Again it is 23, 24. And the CLT, the one to the trust, December 23 still. So all are in the same tax year. Transfer of value. Son, 15,000. Nephew, 20,000. Discretionary trust, 270,000. Now, remember, first, annual exemption is the last, okay? So, to a son, there is marriage exemption of 5,000. Nephew will not get any exemption, only annual exempt. Then annual exempt. 3,000 of the current year and of the previous year brought forward another 3,000. Since brought forward you have used in this first gift, he can't use it for the others because, and current year also you have used, so he can't use for the others. It's used, all are same. So chargeable amount 4,000, 20,000, 270,000. Okay. The procedure to calculate the lifetime inheritance tax on CLT. Lifetime tax should be calculated on each gift separately in chronological order. First, consider the specific exemptions. Because if the gift is completely exempt, you don't have to quantify the gift. Calculate the chargeable amount of each CLT and PET. So value state before transfer, value state after transfer, the difference is transfer of value. Then business property relief and agricultural property relief you deduct, marriage exemption, annual exemption. Like this. Annual exemption is the last exemption. Then chargeable amount. Then third step, calculate the amount of nil rate band available. Remember this nil rate band of 325 keeps reducing when we utilize it against each gift. Okay, it's available after deducting gross chargeable transfer in the previous 7 years. We'll see this below. Calculate the tax on excess at either 20 or 25% depending on who is paying the tax, the donor or the donee. Then you calculate the gross amount of the gift to carry forward for future computation. If required by the examination question, state the due date of payment for inheritance tax. Very important. They will often ask you. So now let us go through the notes. If the gift is into the trust for the benefit of a charity, spouse, qualifying political party, no need to calculate chargeable amount. Why? Gift is exempt. Small gift exemption. Okay, there is no small gift exemption available for gifts in trust. If you are giving any gift into trust, then that 250, less than 250 will not come. That small gift exemption is only when you are gifting it to an individual, individual to individual, not individual to trust. Next, nil rate band. Very important for inheritance tax because you'll be often dealing with this nil rate band. So this nil rate band we reduce from the transfer of value. Okay. Now, since 2009-10, nil rate band has been same. Okay. So for lifetime calculations, the nil rate band at the time of the gift should be used if it's for a lifetime calculation. If a question requires knowledge of the nil rate band for an earlier tax year when it was not 325,000, remember earlier it might have been some different amount. Relevant amount will be given to you in the question, so do not worry. Okay, let's say previous tax year, nil rate band might have been different. They will give you if it's different. But mostly, if they don't mention anything, it's 325,000 for all the years. What are the appropriate rate of tax? Depends on who agrees to pay the tax. Trustees pay the tax. Okay, trustee. If the trustees of the trust, the donee, if donee agrees to pay the tax, the gift is referred to as a gross gift and it will be paid at 20% tax. If the donor pays the tax, the gift is referred to as a net gift and it will be what? As a result of the gift, the donor state is being reduced by the value of the gift and associated tax payable on the gift. What happens? See, why it is net gift? Because when donor is gifting, value of the gift is also reduced and also donor state reduces by the tax that he has to pay because of the gift. That's why gift is referred to as a net gift. So what happens? You have to gross it up. If it's a donor who is paying, you have to calculate the gross amount of the gift. So then appropriate rate of tax is 25%. If it's donor, it's 25. If it's donee, it's 20%. Why? Because 20 of 80th of the net gift. If you do it, it's 25. And this gross transfer. So the gross transfer to carry forward is the net chargeable amount of the gift plus any lifetime inheritance tax paid by the donor. You need this calculation and you need to keep it separately. Remember, your net chargeable amount of the gift plus any lifetime inheritance tax paid by the donor. Add together, you will get the gross transfer that you have to carry forward. And this amount remains fixed for all calculations. Even if nil rate band available at death differs from the amount available during the donor's lifetime. I know it sounds a little complicated, but with calculation you will understand it better. Now, appropriate rate of tax. So in summary, the rate of tax on the value of CLT in excess of the NRV is this pair. If it's the donee, gross gift 20%. If it's the donor, net gift 25%. Note that the tax due on a CLT, it is the responsibility of the donor. Therefore, when a question does not specify who has agreed to pay the tax, always assume donor will pay and the gift is a net gift. What is the normal due date of inheritance? Depends on the date of gift. If the date of gift, this you have to remember, this is the key point in IHT, the due date. How we have due date for income tax, CGT, we have for CLT, inheritance also, we have for VAT also, we have for corporation tax also, different dates. Sometimes it might fall in the same date also. So if your date of gift falls between 6th April to 30th September, due date of payment is 30th April in the following year. If your date is after 30th September, 1st October to 5th April, 6 months after the end of the month of the CLT, the 7-year accumulation period. So for lifetime calculation, to calculate the uh, nil residence band, nil rate band available at any point in time, it is necessary to take account of the total of the gross amount of all the other CLT made during the previous 7 year. You might be having more than one CLT. So in that previous 7 year, accumulate all CLT, the gross amount. Then we'll decide how you have to accumulate the NRV. So this CLT in the 7-year accumulation period are deemed to have utilized the NRV first. There will therefore only the NRV available to match against this latest gift if the total of the CLT in the previous 7 years less than the NRV at the time of the gift. Note that although PAT may use the annual exempt during the donor's lifetime, they do not affect the NRV as they are not yet chargeable. Okay, PAT do not affect NRV. Now the summary of lifetime calculation. Only calculate IST on CLT. Consider IST position for each CLT separately in chronological order. Use the valuation rules. Calculate chargeable amount. Use the NRV for the tax year of the gift. Tax is due 20% if donee pays, 25% if donor pays. Remember, PET are not chargeable at this stage, but they may use annual exempt amount. Annual exemption they will use. Now, before we move on to IST payable on lifetime gift as a result of death. See, before till this time, we were giving a lifetime gift when they are alive. Donor is alive. Now, as a result of death, so we are moving towards death slowly. Before that, let us do questions. So we have 3 questions here. Illustration 1, test your understanding 4, and test your understanding 5. So in illustration 1, A, you have to calculate the amount of lifetime inheritance tax due on the gift into the trust and state the gross chargeable amount of the gift to carry forward. Assuming trustees of the trust have agreed to pay the inheritance tax. Who is paying? Trustees, the donee. Okay. And B, Charlotte has agreed to pay any inheritance tax. Donor. So here he makes a gift into a trust on this date of 366,000, no previous lifetime gift. That means full nil rate band will be available to Charlotte. Now, so A and B are given parallelly to each other. Okay. Calculations will be same. The only difference will come when we have to pay the inheritance tax. The rate will be different. So what is the date that it will be paid? State the due date of payment of tax. The date will be same whether the donor pays or the donee pays. Okay. Now, so first, what is the date? 30th June 2023. So the tax year is 2023-24. What is the transfer of value? It is 366,000 in both the cases. Solution is given. And don't forget to deduct annual exemption, the current year and the brought forward. So in both the case, it will be 3,000 each. That means 6,000. So the gross amount is 360. Here it will be gross. Why? Donee is paying. Here it will be net. Why? Donor is paying. That's the difference. These words are different, but this is chargeable amount. Next, don't forget to deduct the NRV. NRV at the date of gift you have to deduct. The nil rate band. Nil rate band is 325,000. Whether donor pays or donee pays, both. So taxable amount in both cases 35,000. But the rates are different. If the donee pays, like A, it is 20%. If the donor pays, it is 25%. But here there is no issue in A because this is gross amount and this is 20%. So this is your what? This is the amount that will be carried forward. How? This one. This is the chargeable amount, 360,000. This amount only will be carried forward. So your tax is 7,000, and this will be paid on which date? 30th of April 2024. 30th of April. Same for this. But here, one more thing you have to do. What is it? Remember, this amount is net. You have to add the gross up amount to carry forward. So 25% of this is this amount. This you have to add here with 360, the net amount. So, and this will be the gross amount. So your gross chargeable amount, if the donor pays like it be, it will be this. This is the only difference. This area. Everything else is same. Now let us go to test understanding 4. Test understanding 4 and 5 are big lengthy. Okay. We'll slowly try to do each one of them. Okay. It's a big table. So now here you have to calculate IST arising as a result of the LS lifetime transfers. All these are lifetime transfers. State who will pay the tax, the due date, and the gross chargeable amount to carry forward. So these are the following gifts. Okay. The trustees of the first two trusts paid the inheritance tax. Alan paid the tax on the last gift. Okay. How many trusts are there? Discretionary trust, discretionary trust, discretionary trust. Okay. So the first two, okay. This one, these two are paid by trustees. No issue, don't need. Alan pays the gift on this discretionary trust. Alan. Okay. So this is on in the order given from 2013. This is 2019, 2020, 2023. So 183 to discretionary trust, 150 to daughter, 191 to discretionary trust again, 256 to discretionary trust again. Okay. So now let us quickly solve this. So when you are given like this, so many, you can the step to follow is this one. Here we have A and B, gift 1, gift 2, gift 3, gift 4. You have to make different columns like this. At once you can do it. You don't have to do one by one by one. No. In one go, horizontally, you can do it. Okay, so let me show you. Okay, let us do here. If you understood test understanding 4, mind you, everything else becomes easy because all your questions are like this only in your real ATS exam. Even test understanding 5, which will be the next question, after this is same. So let us do that. Okay. Remember, you have to first identify when there are many gifts. You have to identify which of this is chargeable lifetime transfer, which is PET. All the three discretionary trusts are CLT, chargeable lifetime transfer, except this one. This is PET. Okay, that you have to write. Okay, and I write the dates always. So we'll do that. This column will keep for narratives. The first column is always for narrative. This is test your understanding for who is going to pay Alan. This is Alan's. So first gift CLT. Follow the chronological order. Dates are given. 30th June 2013. Next is to daughter. It's a pet. What is the date? Always write the date. This you will be doing in Excel, so it will be easier for you. CLT. Again to discretionary trust on 30th June 2020, and the last gift is again CLT, 31st December 2023. Done. Now first the first thing that we start in inheritance tax calculation is transfer of value. So always start with transfer of value. They will give you, it's given 183,000. 150,000. Here 191,000. Then we have 256,000. Okay. Then do not forget to deduct your what? Annual exempt amount, less annual exemption. Annual exemption, when you are writing, always the current year and then the previous year, and always check the years, because if you're having the same gift in one tax year, you can't carry forward the previous year in for all the gifts, only once, and current year is also used, that's why. But since they are these are in different tax years, so each year, that means for each gift you can utilize the full 6,000. 3,000 current year, 3,000 brought forward, because tax years are different. So current year and previous year. See, this tax year is 2013-14. Always write the tax year 13-14, and previous year will be 12-13. This is brought forward. So 3,000 and 3,000. This is gross because donee is paying. So no calculation required. Straight away, this is known as, this gross will be known as chargeable amount. Always write the correct word, okay? Chargeable amount. These things you have to write. And here also we can do it. This is 30th June 2019. So it falls in the tax year 2019-20, and previous year will be 18-19. Brought forward. Again 3,000. So if you deduct, it's 144,000. That's it. This is pet. Okay, they didn't say that he was alive, like he died, nothing like that. So because she did not die, this 144, there'll be no taxable amount, no inheritance tax on this. Okay, this amount itself will be carried forward, 144, but we'll keep it because this is pet. This you have to deal differently. Okay, coming to CLT. 2021 is the current year, 3,000. 2019-20 brought forward. If you write 3,000, you are wrong here. You are not following the question carefully. Please follow line by line and date by date. See, 2019-20, you can't brought forward anything. Why? Because you have utilized the 3,000 here. So nothing to be carried forward. It is 0. That's why you have to read the question carefully. This is gross. Because the trustees are paying. And then the last one. 2023, 24, 2022, 23 brought forward. 3,000 and 3,000. 250,000. Because Alan is paying the last trust. This is net. Same like the previous one. Now we'll do the nil rate ban and this other deduction. So now the nil rate ban comes after you calculate chargeable amount. Add the date of gift. So write the tax years. 2013, 14, first gift, 2020, 21. and 2023, 24. So first one, for this one, 2013-14 is this one. This we are going to utilize 325,000 here. But what about pet? See, pet we're not utilizing because we are not paying tax here. Then 20, 21. Once again 325,000. And then the last gift. That is also 23, 24, 325,000. Now, less. We have some more on the list. Less. Gross chargeable transfer. It has to be less than, remember the 7-year accumulation period? 7 years before gift. You have to use that. Okay. 7 years from which date? 7 years before gift. When did you make the gift? First gift. This date. 30th June 2013. 7 years before would be 30th June 2006 to 30th June 2013. It would be 0. Because if you see, you didn't make any gifts that time. You don't have any gross chargeable transfer 7 years before the gift. So it is 0. Next, for the pet, it was made on 30th. 7 years before this date, you made 2019. 30th June. Wait a minute. I'm sorry. This is for this gift. 30th June 2020. Pet, we ignore, okay? We ignore pet. Then, so from 20, the third gift in the trust, it will be 2013. 30th June 2013 to 30th June 2020. Yes, we have a gift. We have a gift on 30th June 2013, chargeable lifetime transfer. What is it? It is this amount. Simply 177,000. So we'll deduct it here. 177,000. The 7 year. Okay, it comes little down. Then what's next for 2023? So from 2023, if you go 7 years back, it is 2016. But in 2016, you didn't make any gifts. 31st December 2016 to 31st December. The last gift is 2023. So what is this? Already 177,000 we have taken for one. Pet we ignored. So what is left? This amount, 188. 188,000 we can deduct from here, the last gift, because it falls in 2016 to 23. So 188,000. Okay. And remember, on this date, we do not take this gift. We ignore pet. So pet no. And this we can't take. This gift we can't take because it's too old. It does not fall in 2016. It's before 2016. It does not fall in the 7-8 accumulation period. So we do not take it. It's too old. Okay. We ignore pet and we ignore 2013 CLT because it's too old. So we write it here. For this day, the last gift, we ignore pet and CLT. CLT on the first gift, 30th June 2013, as it's too old. It does not fall in the 7-8 accumulation period. It's more than that. That's why we ignore it. So now, after this, the NRB available. So the first one, 325,000, because nothing was deducted. No gifts made in the 7 years. So NRB is 325,000 only. We deduct from chargeable this thing. And then the taxable amount is nil. Why? Because your chargeable amount is 177. It's less than the nil rate band. So everything is, so taxable amount is 0. No IST payable. IST payable is also 0. Okay. Paid by whom? That you will write if there are tax payable. But here you don't have to write it because no tax is payable. Due date of payment. And then the gross chargeable amount carried forward would be what? The gross amount, exactly this 177,000 only. So it is 177,000. Done. Finished. We finished the first one. Now coming to the next. Next is pet. Okay. So we ignore pet. Because we ignore pet, that means no IST payable. No taxable amount, no IST payable. 0, 0. And what the amount? The 144,000. This amount will be carried forward. Now, the third one. If you see here, you see it's so from 325 we deduct 177. Now the nil rate band available will be, wait a minute, nil rate band available will be 148,000. So 148,000, if we deduct from the gross amount 188, amount taxable is 40,000. And at what tax rate? Who is paying it? the donee is paying it, so it's at 20%. So IST payable is 8,000, taxable amount is 40,000. Who is paying it? Clearly they have told trustees are paying it. Which date? 30th April 2021, because it is the tax year is 2020, 2021. And now which amount will be carried forward? It is this gross amount only. This will be carried forward, 188,000. So now you understood the pattern, I think, right? Next one is little tricky because the donor is paying and it's net here. So from 325 we deduct 188 and the net nil rate ban available will be 137,000. That you deduct from the chargeable amount 113,000. And here because donor is paying, Alan is paying 25% tax, 28,250. 28,250. Because Alan is paying it, what is the date? See the date, it is 31st December. So 6 months after the end of the year. There are 2 days for IST payable, remember? Depends on when the gift was made. So anything before September will be paid by 30th April, and anything after September, this is on December, 31st December. So it will be paid on 30th June 2024. I'm just simply applying the rules here. That's it. But when we are transferring, remember that transferring amount we have to gross it up. What is the amount? 250 net. 250 is this amount. You have to add the gross amount, the tax basically, plus this tax. 28250, which is 278,250. This you will carry forward. That's it. So based on this understanding, now we can quickly do test your understanding 5 in this table itself. Okay. Test your understanding 5 also, if you see, it's similar. Calculate IST arising as a result of CMOS lifetime transfer. Okay. Here also he has made a gift of 123 to discretionary trust, 140 to his son, 221 to discretionary trust, 325 to discretionary trust. Okay. Trustees are paying, Simon paying, trustees are paying. This is on different tax year. Okay. 15th April this and 9 May 2023. So test your understanding 5 we'll quickly do here. Okay, in the same table, since I have already done it, we'll just change the dates. So here also we have CLT, PAT, CLT, CLT. Okay, this time is just Simon and we'll change the date. So quickly we'll do that. Okay, of course you can't do this erase and this thing. Okay, in your exam you have to do it twice, but they will not give you a question like this twice. Okay, this is just for practice. The more and more you practice, the more you learn. This test understanding 5. So transfer of value, already I've written the narratives. 123,000, 140,000, 221,000 and 395,000. Okay, current and annual. Okay, so we'll deduct 3,000. So here first CLT no problem, second CL just change the dates. Okay, accordingly. Okay, we'll write the date. I didn't write the dates here. Wait a minute. the transfer of value comes down. I'm sorry, I've made a mistake. Okay, so first write the dates. Okay, this is 21st April 2015, 15th of April 2020, 19th of 3 2021, and 9/5/2023. Now transfer of value 123,000, 140,000, 221,000, and 395,000. So just change the tax years when we are deducting annual exempt. Everything else is same except here when we come in the third one. Because this year is 2021, 2019, 20. Here also it's 2021, 19, 20. The same tax year. Because it is the same tax year, we have already utilized the current and the brought forward. Here it is 0. So this third gift, you can't utilize any annual exempt amount. Both are 0 because we have utilized it in the second gift, PET. The PET and the second CLT are in the same tax year. Okay. Rest everything remains the same. Okay. This time, this becomes net, the third gift, because Simon is paying, and this is gross. PET will leave it, and the first one is gross. Now we'll change the amount. That's it. First we'll erase. Okay. So that's it. Now we'll write the amount. 117,000, 134,000, 221,000, and 389,000. Okay. Now nil rate band. So when we come to the nil rate band, just change the tax year. 2015, 16, 20, 21. We are not putting the PET. Okay. 23, 24. Okay. 15, 16, 325. Here also is 325,000. No, this is PET. I'm sorry. 325. I've already written 325. Done. Now we'll go to the CLT before gift. Okay. So all these narratives you can write on your own. Answers are given in your textbook behind. I'm not writing the narratives, but what I'm doing is we'll just quickly go to CLT here and 15. Go 7 years back. So it's from 2008 to 15. No gift was made. So it is 0. Already I've done 0. Coming to PET. Ignore PET. Come into the second CLT. It's on 20. 19.3. I'm sorry. It's here. 19.3, 21. So 21, if you go 7 years back, it's 14. So from 14 to 21. In 14, you have made a gift. This gift. This you made after 2014, 2015. This gift. So this you have to deduct from your NRB. Here. 117,000. Because it falls in the 7-year accumulation period. Coming to the last one, 2023. So if you go 7 years back, it's 2016 to 23. So 16 to 23, see, pet you can ignore, okay? And this gift, the first gift, this also you can ignore. Why? It's 2015. It's before 2016. Before the 7 year accumulation period. If more than 7 years, we don't take. So which gift we are taking? Older this year's gift. This is this one, 221. But remember, 221 also we can't take. It's net. We have to first gross it up. How do we gross it up? First, we have to find that inheritance tax for it. So after we finish inheritance tax only, we can find which amount we can deduct from the residence nil rate ban for the last gift. Understood? So we'll keep it as it is. Now we'll quickly go and do finish off our calculation. Everything else is done. So NRB available first gift is 325,000. Amount would be 117. Just 117,000. Coming to the pet. Pet we are not paying. So it's 134,000. Okay, this amount. Coming to the third. It's net. Okay, 325, 117. So it's 208,000. We deduct. And the amount we get for tax is 13,000. Because it is net, 25%. Donor is paying 25. 25 means is 3 to 50. This is the IST. Who is paying it? This time we are paying tax. So we have to write who is paying this gift? Simon. Simon is paying it. Which date? When is it made? 19 March. 6 months from that will be 30th September 2021. Because it's net, when we are carrying forward, it is 221,000 plus the tax. 3 to 50. So it's 2 4 2 to 4 250. This amount. See this amount. This is the gross chargeable amount to be carried forward. 2 to 4 250. We need it for our last gift. This will deduct from the nil rate ban. Understood? 2 to 4 250. Will deduct from this. And then the amount here will be deducting from this amount to get the IST. So what is it? 100 750. We deduct and we get the amount as 288,250. On this, we pay tax at what rate? 20%. It's gross. So 20% tax is 57,650. 20% on this 288,250 is 57,650. Who is paying it? Trustees. Which date? 30th April 2024. Because it is this date. Now, which amount? Here's what is the gross amount here? 389. This only will carry forward. Give thumbs up. $389,000. That's it. It's very simple. Try to do more questions like this. Now we have moved on to the next section from lifetime gifts to IST payable on lifetime gift as a result of death. Now, on the death of an individual, an IST charge could rise in relation to lifetime gifts. See, already we are paying IST on lifetime gifts when an individual is alive. But now when an individual is death, we have to pay extra IST. Okay, within 7 years of death. This rule is when an individual is dying within the 7 years of the date of the gift. If he is dying after the 7 years of death, no IST, extra IST payable. So the pet that was not chargeable now becomes chargeable for the first time. See, chargeable lifetime transfer, we have just done questions. was already payable when the gift was made. Now extra tax will be there, IST. But pet was not chargeable then when we are making the gift. But now because the individual dies within 7 years, first time the pet will become chargeable. Additional tax may be due on CLT. So the IST payable on lifetime gift as a result of death is always paid by whom? Recipient of the gift, of course. The one who is paying, the donor cannot pay the gift on the death. How? Because he is dead, right? So the person who is surviving, that is the recipient of the gift, will pay this tax. Always. There is no question of who is paying, donor or donee. It's always, the question comes when they are alive. So the type of gift, if it's CLT, it is paid by trustees. If it is pet, it is paid by the donee, whoever is receiving, the daughter or the son. Now, calculating. So the death tax should be calculated on each gift separately in chronological order, like this. Identify all the gifts within 7 years of death which are not exempt. Then calculate gross chargeable amount of each gift and any lifetime tax paid. Calculate amount of nil residence ban available after deducting gross chargeable transfers in the 7 years before the gift. Use the NRB on the date of death rather than the date of gift. Transfer the unused proportion of a deceased spouse NRB. See, we'll see this later, but when one of the spouse is dead, the person who is surviving can claim his or her deceased spouse's remaining nil residence back. That means the portion that the spouse have not used when he was alive. So the surviving spouse can use it in addition to his or her nil residence back. Includes PET, the pets are included here, which have become chargeable, but not those that have become completely exempt. Remember, some pet might be completely exempt because they are dying after 7 years. So completely exempt. Those we don't include here. Okay. To calculate the nil residence band available, even the unused portion of nil residence band available of a deceased spouse, we use pet also. We include pet there. We'll see this through calculations. Okay. Now, fourth step, calculate death tax on the excess at 40%. Then we have a relief known as TAPA relief. We have to calculate this and deduct it. Okay. For CLT, deduct any lifetime inheritance tax paid. We have already calculated this, no? Paid lifetime inheritance tax paid. This now will deduct it. And if required by the question, if required, state who will pay the tax and the due date of the payment. These are some further points. Chargeable amount. So the gross chargeable amount of each gift is taxed on death. Gross chargeable amount, not the net. If it's net, you have to gross it up. The gross amount of CLT will have already been calculated in the lifetime inheritance tax calculation. Already is calculated. Remember to use the gross up value of any CLT where the tax is paid by the donor. Why? Because when it was paid by donor, it was net. That's why you have to gross it up. Chargeable amount of a pet is calculated using the values at the time of gift. And pets may use up annual exempt amount also. We have just seen a question, no, previously. For annual exempt amount, pet will use it. Even though they only become chargeable if the donor dies within 7 years. It doesn't matter whether the donor dies within 7 years or not. Annual exempt amount will be deducted from CLT as well as pet. Okay. But the chargeable amount, how do we know when pet becomes chargeable? The chargeable amount will calculate at the time of gift, not at the time of death. Next point, nil rate ban. So the nil rate ban for the year of gift is used against lifetime calculation. The nil rate ban for the year of death is then used to calculate the death tax. When we are calculating death tax, we are using nil rate ban for the year of death. But it is matched against, but still it is matched against all chargeable gifts in the 7 years before the date of gift, prior to the date of gift. And in the 7 years period, we are taking all CLT as well as pet that becomes chargeable. in chronological order. 7-year accumulation period. The 7-year accumulation period for NRB applies in the same way as for lifetime calculation. No difference. Note, it is necessary to take into account the total of all gross amounts of all chargeable gifts made within the previous 7 year, not just CLT. Therefore, to calculate the death inheritance tax on each gift, you have to look 7 years back from the date of each gift and include the gross amount of all CLT and PLT if it becomes chargeable due to the death of individual. This means that a CLT made more than 7 years before death may still affect what your nil rate ban when calculating death tax on lifetime gifts. However, ignore any pet made more than 7 years before death as they are not taxable. Now, next point, death rate of tax is 40%. Any excess over the nil rate band will be taxed at 40%. Now, tapper relief. This tapper relief will be asked. This is often tested when inheritance tax is given. Okay, so this comes along with it. Where inheritance tax is chargeable on any lifetime transfer due to death, amount of inheritance payable on death will be reduced. See, this amount of inheritance that is payable on death, you can still reduce it further by tapper relief. What is this tapper relief? When an individual, okay, have survived 3 years. That means more than 3 years have elapsed since the date of gift. By a percentage reduction according to the length of time between. So this reduction is based on a percentage. How long you are alive and within the 7 years when you are dying. So this length of time is between the date of gift till the death of the donor's death. Now, the relief applies, this relief, remember, tapper relief applies to both CLT and PET. For the first 3 years, no tapper relief is given. Then after the 3rd year, 20% relief is available. This is the table. If you are surviving more than 3 but less than 4 years, you can reduce the inheritance tax by 20%. If you are living for more than 4 but less than 5, 40, more than 5, less than 6, 60, more than 6, less than 7, 80%. So each time 20% more you are adding. You are getting more and more relief if you are surviving more. But remember, it has to be more than 3 years and less than 7 years. First 3 years, if you are alive, die, full tax you have to pay. There is no tapper relief available. So this table you have to follow. This table is given in the exam, in fact. So for gifts made 7 years or more years before death, there is no inheritance tax payable on death. That's why tapper relief is not relevant also. Now, so for CLT, any lifetime inheritance tax already paid can be deducted from the liability calculated on death. However, remember, no refund is made if tax paid already is higher than the amount now due on death. You might have paid tax higher than the amount that is now due on death, but you will not get refund for it. At best, what can be done is deduction of the lifetime tax paid will bring the liability on death down to 0, down to nil. What is the normal due date of payment of inheritance tax on death? 6 months after the end of the month of death. You can die on 13th October, but it will be taken from 31st October only. 6 months from 31st October, because end of the month, which month did you die? October. They are not taking the date. It can be 10th October, 12th October, 13th October. End of October is 31st. So from 31st October, 6 months. 30th of April, like that. So inheritance tax as a result of death is due 6 months after the end of month of death. See, when it is for lifetime tax, there were 2 dates depending on the date of gift. If it falls between this date. If it falls between this date. But for death, only 1 date. 6 months after the end of the month of the date, no question. Now let's do questions. Illustration 2. So we have the solutions with the questions so that this saves a lot of time, and in the solution I will explain you how we got the answers. So we have illustration 2, then we have illustration 3, then we have illustration 4, and we have test your understanding 6. So these are the 4 questions that we are going to attempt, and if you see, each question has a similar layout. So let us first start with illustration 2. Okay, in each you have to calculate IHT as a result of the death on this day 30th June 2023. State who will pay the tax and the due date of payment. First we'll work on the calculation part. Okay, so when it's a calculation, and when we have different gifts, remember we have to follow this column way of doing inheritance tax. This column you can do it in Excel. Okay, so there are 3 gifts. First gift is to the son, second gift is to the daughter, third gift is to the son. All are pet. That's why we are writing pet, pet and pet. It's very important that you clearly write next to the gift what type of gift it is. Is it a chargeable lifetime transfer or a pet? If it's to a trust, it's a CLT. If it's to a son or a daughter, to an individual, it's a pet. And some of the gifts are exempt from IHT, like charities and all. Now, chronological order is very important. You have to write the date of the gift. First gift is 31st July 14, 30th November 19, 30th April 20. So they are writing the dates here. This is the first gift, this is the second gift, this is the third gift. And it should follow the chronological order. You can't miss out on that. First one first, second and third. Usually they will give you in that order only. First gift, second, third, from the oldest to the latest. Then our starting point is from the transfer of value. This is the first point. If you see in any answer where you have to calculate IHT, this is the first thing. Transfer of value is often given to you. It is just the value of the gift. 80,000, 110,000, 235,000. That's what we are writing here. Now deduct annual exemption. Annual exemption 3,000 current year, 3,000 brought forward. For that you have to mention the tax year. This gift falls in 31st July 2014. That means tax year is 14-15. Previous year will be 13-14. Since this is the first gift, no issue with annual exemption. You can deduct 3,000 and 3,000. Done. And you get 74,000. This is the gross chargeable amount. Okay. This IST will be payable as all our pets. Now, coming to the second. Second, it is 30th November 19. So 1920 is the tax year. Previous year is 1819. Here also 3,000, 3,000 you can deduct. 104. This is the chargeable, gross chargeable amount to be carried forward. See, IST payable here it's nil. It's 0. Why? Because it's pet. During the time of the gift, no IST is payable. But the amount to be carried forward, the gross chargeable amount carried forward will be the chargeable amount. Because we have to see whether they are dying in the 7 years or not. If they die within 7 years, IHT is payable. If they die after 7 years, no IHT. So that's why this to be carried forward. Next here. Here when we come, it is 30th April 20. 2021, no problem, but here it is 0. Because 2019-20. Why 1920? See, 1920 we have utilized in the second gift, 3,000. Annual exemption we have deducted. So again, we can't deduct here in the third gift. Already 3,000 utilized in the second gift. So third gift you can't. That's why it is 0. That's why the dates are very important. Please follow the dates in IHT. Then it is this. And this will be carried forward. No IHT. You have to write the 0. The 0, 0, 0 is very important. IST payable with 0 as all are pets. You have to write it. Why it is 0? Because all are pet. But this will be carried forward. So this is the same structure. Any IST you have to do. If you have 4 5 gifts, there will be more columns like this. If 5 gives 5 columns, 3 gives 3 columns. Okay. Now, so we'll write the solution. All gifts are pets, therefore no lifetime tax to pay. But gross chargeable amount of the pet must be established at the time of the gift. But still you have to find that gross chargeable amount, because we want to find out whether later, because due to death we have to pay the tax or not. That's why. So what is the date of the death? It is this. When does the 7 years before falls? You only have to see the 7 years before the date of death. Okay, that is 30th June 2016. That means any pet that falls after 30th June 2016 till this date will be chargeable. Any gifts before 30th June 2016 are not chargeable. They are exempt. So we'll see the first gift. It is 31st July 14. It's before 30th June 2016. So the first gift is more than 7 years before death. Therefore, no IST payable on death. But the other two gifts, because they are after 16, they are the second gift and the third gift. You have to pay IST. Remember the gross chargeable amount that you carried forward, 104 and 232. Now that is your starting point. But keep this calculation and this previous calculation separate. Okay, this needs to be separate by some few lines. Okay, then now you need the nil residence band. Once you carry forward the gross chargeable amount, you need the nil rate band. It's very important. The nil rate band is 325 and 325. But we have to see whether this nil rate band is reduced further by any gifts made 7 years before the date of the gift. 7 years accumulation period, this one. Gross chargeable transfer 7 years before the gift. 7 years from this date. It will be 30th November 2012 till this date. Did you make any gift? No. Why? You made a gift. You made a gift. This was the gift. But this is exempt. No IST payable. Okay? We ignore. See, in the bracket they have written the reason. We ignore this first gift. That means first gift will not utilize the nil rate band. Why? As it is completely exempt. That's why it is 0. That means full 325,000 you can utilize against the gross chargeable amount. And now your nil, so that means this full amount is available. Deduct from this. If you deduct, this amount is less, nil rate band is more, that means taxable amount is nil. It can't be negative, it's nil. Okay, now coming to the second, the last gift. Last gift will have some nil rate band. See, which nil rate band? This gift, this will utilize the nil rate band. When we are utilizing nil rate band in the third gift, the second gift will come. Second gift nil rate band, since you have utilized it, you have to reduce it from 325. That's why nil rate band is now this much. So this you deduct. This is taxable amount. What is the IST at death? 40%. That's why it's 40% of 11,000 is 4,400. Remember the tapper relief if they are dying within 7 years. You have to remember the dates. When was the gift? Third gift. 30th April 20 and death was 30th June 2023. It falls 3 to 4 years. 3 to 4 years, it will reduce by 20%. The rate is 20%. So 20% of 4,400 is 880. Okay. Did you paid any IST in lifetime? If you paid, you have to deduct. If you don't pay, you don't have to deduct. You didn't pay. Why? Because it was a pet. So during the lifetime, we didn't pay any IST. Remember, this IST paid in lifetime is for CLT only. This is pet. So it will be 0 only. So IST payable on death is this much. From 4,000, we deduct the tapper relief 880. 3520. Now, they also ask two questions. The date and who will pay. Who will pay? Donor dies. So the donee, always the donee. The son will pay. the last gift. And when is the date? 6 months after the end of the month of death. So they died June. 6 months from June will be 31st December 2023. This is the date. So clear? Now let us go to illustration 3. Illustration 3 we can quickly do because there is one gift, and that is to a trust. So this is a CLT, not a pet, and this is the value, transfer of value. No lifetime transfer was made, died on this date. Okay, again calculate IST, lifetime, when from death, who will pay, and due date. Same question. The only thing which changed is this is not a pet, this is CLT, and one gift only. So it's easier. Transfer as values given, deduct annual exemption 3000, 3000, this one, and annual, the nil rate band will be this much only because no gift made in the previous 7 years. So taxable amount, and take, remember this is CLT. So in lifetime, donor will be paying. Donor will be paying at what rate? 25%. So 25%. They already told. The IST, see, when it is CLT, they will tell who pays, donor or donee. So it is paid by Zandra, donor. So donor pays always 25%. 25% of 74,000 is this. And remember, because donor is paying its net, you have to gross it up. When we are carrying forward, we have to gross it up. So remember, this is net chargeable amount. That's why this is net. So this 25% tax, 18,500 you have to add with this, and you carry it forward, not 399. Remember, all this while it was gross when it was pet. But when it comes to CLT, it becomes net if the donor is paying. Here Zandra is paying, that's why it's net. If it was the trustee who are paying, it would be normal, gross only. No need to add the tax. Here you have to add the tax, 18,500. And you will carry it forward, then this becomes gross. Who is paying it? Zandra. When is it? See, this is CLT, no death. During lifetime, what is the date? Rule for the lifetime? Look at the due date of the gift. When is the due date? Is it in the first half of the tax year or second half? 15th November. It is after September. After September means it will be 31st gift in the second half of the tax year. 31st May 2017. Six months from the end of the tax year. End of that month. End of the month is November. 15th November. So 30th November. So from 30th November takes 6 months. That's why it's 31st May 2017. The due date. Now, because of death, what happens? Remember, this gross chargeable amount will be carried forward. This will be the nil rate band. No gift was made, so this is the nil rate band. This is the taxable amount. Because it's death, 40% on this. And remember the TAPA relief. Gift was made 16, he died 23, 6 to 7 years. TAPA relief will be more because he survived more. So 80% TAPA relief. Reduce from this, this is the amount of IST. Remember, one more thing. We paid IST in lifetime because this was CLT. How much we paid? 18,500, right? This we paid. This we have to go again and deduct from here. After we deduct TAPA relief. See, we calculate IST at 40, deduct TAPA relief. That time we have to deduct this 18,500. Otherwise, it will be double tax, no? Twice you have to pay. So this IST that you paid in lifetime is more than this amount that you are paying in death. That's why IST payable on death is 0. There is no repayment of lifetime IST. Remember, in your lifetime you paid more tax than that was due in death, but you will not get any repayment. Sad, but that's the reality. Coming to illustration 4. Here we have many gifts. Some CLT, some pet. Now you know the nature of pet also, CLT also. Together we'll do this question. Very easy. Calculate IST on lifetime, on death, who will pay the tax, due date. Same question, but the gifts are more. First gift is a trust, second gift to son, third is trust, fourth is daughter, then is interest in possession trust. So this is CLT, this is pet, this is CLT, this is again pet, this is CLT. Who agrees to pay any tax on CLT? Mark, donor, net, 25%. Mark died on this date. This is already in order. You don't have to shuffle. So the transfer of value is given 120, 262, 236, 21, 93. So quickly we'll go to the table and do you see the dates of the gift are given CLT, PET, CLT, PET, CLT. Dates are given. Okay. Transfer of value is given from the question. No problem. Deduct annual exemption tax year, current tax year, previous tax year. Current tax year, so this is 3000, 3000, 3000, 3000, 3000. No issue. When we come here we have already deducted. That's why here brought forward is 0. And here 3000, 3000. Here also 3000. But here when we come again 2020, 122 we used here. So here it is 0. So now wherever it is CLT, it's net. Donor is paying. We have to gross it up later. Okay, this amount, that is chargeable amount. Now coming to the nil rate band. Okay, see for pet. Okay, for pet will not utilize any nil rate band now at the date of gift. Why? Because it is not chargeable. That's why straight for pet 256 gross chargeable amount, 15 gross chargeable amount. This is 0. Taxable amount is 0. IST payable is 0. See, during lifetime, this is during lifetime. Divide your IST into two parts when we are calculating. Don't mix first lifetime, then death, lifetime, death, lifetime, death, like there are two tables. So during lifetime, no IST for pet, no taxable amount. Here also is same, 0, 0. Our only working is in the CLT. Okay. First gift, no issue. Straight away, because no gift was there 7 years before this. This was in fact the first gift. So nil rate band during lifetime is 325. So if you deduct 325 from this amount, you see it's nil. But here gross chargeable amount that you have to carry forward, you have to add tax. Since you didn't pay any tax here, nil tax. With which amount? This amount. So 114,000 itself is the gross chargeable amount because no tax paid. This will be carried forward when we do the tax during death. That's why you have to carry it forward. Coming to pet, no issue. Then come to the third CLT. Second CLT. Here when we come to 325,000, we have to deduct 114,000. This is the first gift. Because that will utilize the nil rate band now. You see? Why? Look at the date. 7 years. If you see 7 years before this, it's in 1/6/2012. And this is after 12. So your nil rate band reduced to 211. Then this is the taxable amount. At what rate? 25% because donor is paying. This is the amount. So this amount 5,000 you have to add with this gross carry forward. Who will pay? Mark. Here also mark. Which date? This is during lifetime. So 30th April. Okay, end of the tax year. 30th April 20 because this is 19 after the, and this is 2022. So it will be 30th April 2023, the due date. Coming to the last CLT. Here from 325,000, you will deduct what? This gross amount you have to deduct. Not 233. This gift will be deducted from here. Remember, pets will not, you will not utilize pet again, nil rate band, because we are not utilizing any nil rate band during the lifetime of pet. Pet is exempt in lifetime. Only death will see whether it is 7 years before or after. So this amount. So this is your nil rate band. Then this. Then 25%. This 875 will add with this amount because it's net 90,000 and this will be carry forward. Done. Now, so we'll go. Date of death, this. 7 years before this. So if you see 1st December 2016, this will not come. From here onwards, it will come. You see, this also will be chargeable because it's after 1st December 2016. So the first CLT is exempt. Therefore, no IST payable on death. It's more than 7 years before that, no IST payable on death. So our first will be PET, CLT, this one, this one. Everything remains the same. Whatever you have carried forward, write it again. Now the nil rate band during death. There are two nil rate band, one at the lifetime, one at the date of death. It will be 325, 325, 325, 325. But how much we utilized? Remember, we have to see 7 years before gift. Before the date of gift, we have to see 7 years back. Do we have any gift? If you see from 18, 7 years back, yes. 7 years back means 1511. 1511, this is 1913. This gift was made 7 years, within 7 years time frame. That's why 114 will deduct. Always includes CLT. This is your nil rate band. This. Because his death, tax is 40%. This. And remember the tapper relief. He stayed alive from 1518 to this date of death. 5 to 6 years. Tapper relief is 60%. No IST paid in lifetime because it was a pet. So IST payable on death is this. Who will pay? This is pet. So the donee will pay. Alexander the son. What is the due date of payment? Is the death. 6 months from the date of death. It is 1st of Jan. When is the death? 1st of December, sorry. So 30th June. 6 months. Coming to the next. Here also. Here, from the nil rate band, we have utilized more. How? 114 the first gift and 256 the second one. The pet. 114 this one. 256 the pet. Pet also will come here because it falls in the 7 year from 2019 if you see. All the dates are given here. You will include pet because now it becomes chargeable. They have shown you the calculation here 256 and 385. How they have got. Okay. Earliest one will go out because it's more than 7 years. So 375. 370. So it's more. More means it is 0. So the whole thing is taxable. That means they don't have any amount to utilize. Okay. 40% tax. Tapper relief is 40 because they stayed 4 to 5 years alive. Looking at the date. This is the lifetime people. They paid this much tax in lifetime. See, this was CLT. They paid 5,500. So you see here, you have to go up and check how much you paid for that gift. 5,500. That you deduct. This is the gift. Who will pay? Trustee. And on this date. The dates are same. And here also trustee. Here it is Jane. Now coming to the pet. Here it's more. It's growing and growing. Here it's even more. It's accumulating. Because there are so many gifts. So here the first, second gift, third gift, fourth gift. Because it falls from this date to this. Always go 7 years back and check. Accumulate the 7 years. That's why it's more here. Here also 0. Okay. So 15,000, the whole is taxable at 40%. Now, remember they have died less than 3 years. They didn't survive for at least 3 years. That's why no tapper relief. Everything is taxable. This is pet. That's why you didn't pay any IST lifetime. So 6,000 is payable on death by Jane. The date. Now coming to CLT. Here if you see. From 2022 if you go 7 years back. You see it's from 15. They have written the dates here. All the workings are here. Please read and see. It's there in your textbook. So earliest CLT will be dropping out. Automatically it will drop out. So you will include both the pets. Okay. So now I'll include it, get it. This is again 0, then this, and 40%. Here also, because he survived less than 3 years, so no TAPA relief. This is the IST payable. You paid some IST because this is CLT 875. You see this 875. Deduct. Yes, about that. It looks little lengthier, but trust me, it's one of the easiest question and easiest to score if you understood, because it's the same. The standard is same. Now the last question for this test understanding 6. Same. Calculate IST. If he dies, additional IST and nil rate ban left to set against the death state. If he dies on 14 Feb 2024. Okay, these are the gifts. This is to a trust, CLT. This is niece, pet. This is nephew, pet. This is trust again, CLT. Okay, who will pay trust? Amal. Here, trustees. So niece and nephew on the occasion of marriage. Remember, there is a marriage allowance. Okay, now it's the same. Okay, so quickly write the dates of the gift, CLT, pet, classify them. There are 2 pets in between, and CLT dates are there. Then the transfer of value is already given. Deduct annual exemption. First marriage exemption comes. Annual exemption is always the last one. Marriage exemption is this one, the one which he has given to his nephew. Remember, any gifts to any party up to 1000 you can deduct. Marriage exemption is 1000. This rules you have to remember, these exemptions. Okay. Then annual exemption. Current year, previous year. So 3000, 3000, 3000. But here it is 0 because here you have utilized 1516. Here also 3000, but here again 1615 brought forward has been utilized here, that's why it's 0, and here 3000, 3000. Done. Because he's paying Amal net. Rest everything no doubt. This is gross because trustees are paying, and this no net gross because it's pet. Now, after this section, after you deduct annual exam, marriage exemption from transfer of value and get the chargeable amount, next is NRB, near rate ban, at the date of gift. So start with 325,000 and 325 because both are CLT. Pet, no need to consider at the date of gift. Since this is the first gift, nothing to deduct. Full 325 you will get against this. Net is lower than nil rate ban. So taxable amount is 0, IST payable is 0. Because no tax, so 199 itself is the gross amount. Correct? Now, this amount you will carry forward, no tax here, no tax because pet, and same here. Coming to the last one. See, this 199 you will utilize here against this nil rate ban. It falls in the 7-year category. Check the date, 15 and 21. So this is the nil rate ban available. Deduct from here. It's 4000, 20% because who is paying? Donee. Trustees are paying. That's why it's gross. And 20%. 800. Who is paying? Trustees. Which date? It's lifetime, right? So from April, December, January, February, March, April, May, 6 months from the end of the month of the gift. That means from 30th April take 6 months. So 31st May 2022. Okay. Now, this gross chargeable amount only will be the starting point for what? At the date of death. This is the date of death. 7 years before is this 14 Feb 17. So for 14 Feb 17, if you see this one and this one are exempt because they fall before that. So only the last pet and the last CLT. Two things we have to worry about. 130, both are 130. Here 325. Okay. So here when you deduct 325, remember this is NRB at the date of death. Here also when we are checking NRB, we have to see whether we are making any gift 7 years before the date of this gift. 7 years means from 2017, 7 years if you go back 2010. So 2010, there are two gifts, 199 and this one. Remember, this is pet. We didn't utilize any NRB, but 199, yes. So 199 will deduct from here. This is the amount, this one. Because his death, 40% is the tax rate. He remained alive 6 to 7, so 80% is the TAPA relief. The more he stays alive, more TAPA relief. No lifetime IST paid because pet, 0. IST payable on death is this. Who is going to pay? Nephew always, because the uncle dies. What is the due date of payment? When did he die? 14 Feb 2024. 6 months from the end of Feb. March, April, May, June, July, August. 31st August 2024. Same date here also. But here trustees will pay. They have already mentioned. Here also 325. But here when we are utilizing the NRB, remember the first 199 and 130 also. Which 130? This 130. But this and this, sorry, this 57,000 we are not including. It is totally exempt. Does not fall in the 7 year. Okay. So that's why this exclude. But include the second part because it becomes chargeable. So that's why 130. This is more than 325. That means this is 0. This IST is 40%. No TAPA relief because he was alive for less than 3 years. So TAPA relief is 0. How much you paid in lifetime? This is CLT. You paid 800 tax. This have to deduct from here. This is the amount of tax. Now coming to the part C. What is the annual rate ban against the death state? 325. Okay. 7 years before death. When is the date? 14 Feb 24. 7 years if you go back from this date. So from this date, 14 Feb 17, only two gifts, just two gifts you have to take into consideration. 130, 130, both are 130. We don't take the first two gifts. They are too old. Okay. They are more than 7 years. And you have to include pet. That means this 130 on this date. Why? Because it becomes chargeable on death. That's why this 130. So 260. So this much of nil rate ban will be available against death state. Next item on the list is fall in value relief, FIV relief. This is new for ATX, was not there in taxation. So very high chance of this occurring in your exam. The chargeable amount of a lifetime gift, it could be CLT, it could be PET, is calculated and fixed at the time of gift. If the gift becomes chargeable on the death of the donor, okay, any increase in value from the date of the gift till the date of the donor's death is ignored, which is good. It's giving you a protection against the increase in value. If the asset decreases in value from the date of the gift till the donor's death, there's a relief given to you. That relief is given for you to reduce the chargeable amount on the gift. Chargeable amount of this gift on death. That means you have to pay lower tax. But there are conditions. What are the conditions? Asset must be still owned by the donee at the date of the donor's death, or it was sold in an arm's length transaction before the donor's death. Note that this relief is not available in respect of any property which is expected to fall in value over time. See, if an property is expected to fall in value over time and you know it, you are giving it as a gift, assuming you can claim this fall in value relief, you are wrong. For example, any plant and machinery we are giving to someone, we definitely know plant and machinery depreciates, it falls in value, impairment is there. So, with that thing in mind, if you give it as a gift, you will not get this fall in value relief. Next, any vesting chattel, if you are gifting as a gift, you will not get this fall in value relief, even if the value falls. Vesting chattel means tangible movable property with a useful life of 50 years or less. How does this relief operates? It reduces the chargeable amount by the fall in value. How we deduct tapper relief from inheritance tax? We deduct fall in value from the chargeable amount. And this is calculated from the donor's point of view. Because the donor dies, no? Why should we care? So the fall in value is the difference between the value of the asset at the date of gift and the value of the asset at the date of the donor's death, or the date of the sale if earlier. See, before the donor dies, if the donor is selling the asset, then whichever is earlier, on that date you take the value of the asset, compare it with the value of the asset at the date of gift. The difference between these two is known as fall in value. Now, this relief applies to both PAT and CLT, but only affects the calculation of inheritance tax on that one gift. Has no effect on lifetime inheritance tax already paid. If you have already paid inheritance tax during your lifetime, it will have no impact, no effect. And has no effect on the IST payable on any subsequent gift or the debt's death. Therefore, the original gross chargeable amount is accumulated and carried forward to calculate the nil rate ban on subsequent event. Now let us do a question on this. Test your understanding 7. We have two parts. First part, calculate IST liability. B, calculate gross chargeable amount to carry forward on the death state computation. Okay. Now, Tim died on this date. On 30th April 2020, made a gift of 100,000 shares, one person holding in ABC PLC quoted company into discretionary trust. Tim paid the IST arising on the gift. Tim paid no other lifetime gift. ABC shares were worth 3.65 each on this date and 3.35 each when Tim died. You see the value fell down by 0.3 pence. So we'll see that. What is the transfer of value? 100,000 shares into 3.65 because that was the day the gift was made. So 100,000 into 3.65, 365,000. Now deduct annual exemption 3,000, 3,000. 3,000 current year, 3,000 previous year. Okay. Because team is agreeing to pay its net. This is the amount. Nil rate ban 325. Did you make any gift previous 7 years before the gift? No. So 325,000 is only available. Taxable amount is 34,000. And he is paying team is paying so 25% tax. This one. This 8,500 should be added with this net chargeable amount to find the gross amount. And what is the due date? Remember the gift was made in the first half of the tax year. So it will be paid by 30th April 2021. When was the May 30th April 2020? First half of the tax year. Now, that is IST payable on lifetime gift. Write the heading. This is IST payable on death. Clearly you have to write like this. Okay. So this amount carry forward 367,500. Now, difference at the gift 365 and at the debt 335. Difference is 30,000. Fall in value is 30,000. So this 30,000 you can further deduct as a fall in value relief from here. So your chargeable amount falls by 30,000. Again now nil rate ban at the date of death is this. No gift, only one gift, so it's 325 only. This is the taxable amount. Tax is 40%. Will we get TAPA relief? Yes. He was alive 3 to 4 years, so 20% is TAPA relief. 20% of 5,000 is 1,000. And if you deduct lifetime, you have paid lifetime IST of 8,500 that you have to deduct. And if you deduct 5,000, 1,000, 8,500 IST payable on death, no repayment of lifetime IST paid. So life IST payable on death is 0. Coming to B. So remember, for the death state to carry forward, it will be 367,500 only. Your gross cumulative total to carry forward is 367,500, not this one, not after the fall in value relief. Okay, it will remain originally as it is. It is the original gross chargeable amount per lifetime IST calculation. Per lifetime IST calculation, not during death. That fall in value relief is given only on death. But for death state, if you have to carry forward, original gross amount remains, not after the fall, not after 30,000 fall. It is 367,500, not 337,500. This thing only you have to remember. The last part of this lecture is IHT payable on death state. We have done two parts, IHT on lifetime gift, IHT on death. Now, IHT payable on death state. This is a longer one, but what are the things you have studied previously for the other two parts applies here also. When an individual dies, IHT arises on the value of that individual's state. Detailed computation of death state will be covered in lecture 15. But this lecture explains the basic thing, how IHT charge is calculated once the state value has been calculated. What are the procedure to calculate IHT on death state? Very important from the point of your ATX question. You have to know how to deal with the questions. First, deal with any IST on lifetime gift. Remember, always start when we have three things: lifetime gift, death IHT payable on the gift when a donor dies, and death state. You always start with the IST on lifetime gifts. Okay. So deal with the IST on lifetime gifts within 7 years. But there's a time, not any lifetime gifts. Within 7 years of the date of death. First, before dealing with state computation. All the things that we have covered before. IST on lifetime gift. When a donor dies. That you have to be calculated first before death state. Remember this always. Don't go and start jumping to death state first. Second, calculate the gross chargeable state value. Third, calculate the residence nil rate band. All this while we are having nil rate band. Now we have residence nil rate band. Residence nil rate band might not always be available. If it's available, you have to calculate. Question will tell you. Calculate the nil rate band available after deducting gross chargeable transfer in the previous 7 years, and this will include both PAT and CLT. This up to this much we have done. And calculate the tax on the excess. That means death tax. Death tax is usually 40%. Till now we know it's 40%, but this 40% can be further reduced to 36%. How? If at least 10% of the baseline amount is left to charity. We'll see what is this baseline amount. Okay. 6th step, deduct quick succession relief and double taxation relief. We'll study both this in chapter 11. Okay. If it's applicable. And if required by the questions, if required, if do not require, don't ask, answer. If required, state who will pay the tax and the due date of payment. Now, further points. 7-year accumulation period, very important. So this 7-year accumulation period applies in a similar way to the death calculations on lifetime gift. Like this. Take the total of the gross amount of all chargeable gift made within the previous 7 year. Therefore, you have to look back 7 years from the date of the death and accumulate all the gross amount of all CLT and all PLT if it becomes chargeable on death. If it does not become chargeable on death, if it is exempt, it is exempt. See, anyways, any pet within 7 years of death will be chargeable. Okay. Now, nil rate ban. Nil rate ban available on death is 325. Okay. This 325 is first used to calculate the death tax on lifetime gift. Then the state, after the lifetime gifts had been dealt with. So this 325,000 will reduce by two things. First, lifetime gift, death tax on lifetime gift, then the death state. Two things. So that means 325,000 for the death state will be the remaining portion, not the full 325,000. Then residence nil rate ban. Residence nil rate ban is up to the maximum of 175,000 for 23-24 tax year. This is an additional nil rate ban, additional to 325,000. But do not add with nil rate band 325, 175 and show as one figure. No, no, no. Nil rate band separately you have to show. Residence nil rate band separately you have to write. Okay. And this is available when we are calculating IST on the death state. Okay. This is only available on death state. When a main residence, see, you have to have a residence. If residence is not there, you will not have the residence nil rate band. Where a main residence is inherited on the death by the deceased direct descendants. That means you are getting a residence from your father or a mother or your grandfather because you are a direct descendant. Not anyone else, direct descendant. If it is by aunt, if it's some nephew, it is some niece, some charity who is getting this residence, then this nil rate band will not be available. Okay. Then it is known as residence nil rate band. Further points. This applies when we are calculating tax on the death state only, and the date of death should be on or after 6th April 2017. Before this was not there. Remember, it should be the main residence and it should go to the direct descendants. That means child or grandchild. So for the purpose of your examination, question will make it very clear whether residence nil rate ban is available or not. So you don't have to worry about it. Examination team has stated that if there is no reference to a main residence within a question, that means you have to assume there is no residence nil rate ban. That's it. Unlike the normal nil rate ban, the residence nil rate ban is not available when calculating additional tax on lifetime gift as a result of death. See, nil rate ban we are taking twice, during lifetime when the donor dies and also death state. But RNRB is not like that. It's only available on death state. So that makes your work very easy. Okay. If a house is given to a child during the lifetime, residence nil rate ban will not be available when we are calculating death tax. Yes, you might say that pet becomes chargeable because it is within 7 years, but still residence nil rate ban will not be available that time because it is not on death state. The only exception to this would be if the house was treated as a gift with reservation. See, the only way you can claim residence nil rate ban under this condition is when we are saying we are getting the house with reservation. How? It is a gift with reservation and it is included in your death state. In this case, residence nil rate ban of 175,000 will be available against your state. Only one property can qualify for residence nil rate ban, only one. Buy to let properties are not eligible for RNRB. Available RNRB is the lower of 175,000 and the value of the residential property. Could be less than 175. Whichever is lower is your residence nil rate band. Okay. The value is net of repayment mortgages. After you deduct your repayment mortgages, whatever the value. In calculating the tax on the death state, see, we still didn't go in the detailed calculation of death state. That is in the next chapter 15. But I am saying in calculating the tax on death state, the residence nil rate band is applied before the normal nil rate band. Remember the order. Residence nil rate band first, then the normal, then the nil rate band. Now, this is new. Tapered withdrawal of residence nil rate band. Even residence nil rate band could be what? Reduced. Could be withdrawn. How? We'll see how. From states with a net value exceeding to 2 million. But this net value is before deducting APR, BPR and exemptions. What is APR? Agricultural property relief. BPR is business property relief and exemptions before deducting. That's why I've highlighted before. Whatever is the net value of the state, if it exceeds 2 million, at a rate of 1 for every 2 exceeding the threshold. Remember, if it exceeds 2 million threshold, residence nil rate band will reduce. This is same like how personal allowance and income tax is reduced. If it's more than 100, adjusted income, net income is more than 100,000. It reduces by half. Same. So this is how it reduces. If your residence nil rate band, this will reduce to nil if your net state is 2,350,000 or more. How? Just check. 175,000 into 2 plus 2 million. So 2,350,000 or more. Reduce for. Residence nil rate band in that condition is 0. You can transfer the nil rate band which are not used. Okay, not just nil rate band, residence nil rate band also, which was not utilized, can be transferred to the surviving spouse. Whoever is dying at that person's death, if still there are some remaining residence nil rate band or nil rate band, it can be transferred to the surviving spouse. Surviving spouse can claim it, which is good. That means it's not wasted. In addition to the surviving spouse's nil rate band and residence nil rate band, further he can claim the his or her spouse's unused nil rate band. So as a result, each spouse can leave his or her whole state to the surviving spouse. What happens if they leave the state to the surviving spouse? The couple will not lose the benefit of nil rate band and residence nil rate band. So the surviving spouse will have benefit of two things: his or her own residence nil rate band and nil rate band, and any unused portion of the spouse's nil rate band and residence nil rate band. Now, the amount that can be claimed is based on the proportion that was unused by the first spouse to die. The unused portion is applied to the nil rate band available on the second spouse's death. The executor of the surviving spouse must claim the transfer. Who claims it? Whoever is executing the surviving spouse. The executor of the surviving spouse must claim the transferred nil rate band and residence nil rate band by submitting the IST return by the later of this due date. 2 years from the second death or 3 months from the executor starting to act. Sometimes it happens that both the spouse dies. First one, second one. Still, whoever is executing, the executor can claim. So the increased amount of nil rate band can be used against any lifetime gifts taxable as a result of the donor's death and the death state also. The increased amount of residence nil rate ban can also be used against residential property left in the death state to direct descendants. Now, the transfer of the residence nil rate ban is available when the first spouse died before 6 April 2017. Why? Because this is the date that residence nil rate ban was introduced. Provided the surviving spouse died after 6 April 2017. That means one spouse, first spouse, has to die before 6 April 2017. Second spouse has to die after 6 April 2017. If both dies before 6 April 2017, you can't transfer this residence related ban. So in this case, what is the unused portion of the residence related ban? Will always be 100%. Why? Because when the first spouses die, he cannot utilize the residence related ban at all. Because that was the date when the residence nil rate ban was introduced, that is 6th April 2017. If that date only he dies, he can't use any residence nil rate ban. So the surviving spouse will get the 100% of that. So 175 plus 175. Now, the normal due date of payment on inheritance on death. So as a result of the death, IHT as a result of death is due on the earlier of these 2 days, 6 months after the end of month of death or on delivery of the account of the state assessed to HMRC, whichever is earlier. Note that who pays the tax on the state value depends on the composition of the state. This is covered in detail in lecture 15. Now, the last part. And then we'll do some questions and we'll finally summarize this lecture. Tax planning. This is very important from your ATX point of view. ATX, you will get questions on tax planning. It could be any tax, inheritance tax, corporation tax, VAT, income tax, capital gain tax. Any type of tax planning will be there. So qualifying residential property should be left to whom? Direct descendant. In priority to other assets. See, other assets you can leave it with anyone. But if it's residential property, make sure it is left with your direct descendants, your child or grandchild. Why? Because they can claim residence nil rate ban. Others can't claim. Okay. Next. If you are leaving the residential property to direct descendants, you can save inheritance tax of up to 40%. 40% of 175 is 70,000. Which is into 2. When we are getting the unused residence related ban from their deceased spouse, it will be into 2. So 140,000, up to 140,000 IHT you can save. If, let's say, individual dies and he did not leave the main residence to direct descendants, what can he do? He can still, through the deed of variation, can leave the residential property to direct descendants. He vary the will. Now, before we summarize, let us do questions. There are 5 questions which we are going to attempt, the last 5 questions, and with this we'll finish a basic understanding of IHT. That is illustration 5, test your understanding 8, test your understanding 9, 10 and 11. Okay, I already have the solutions with me. So, without wasting much of your time, okay, now let us start with illustration 5. So, there are 2 things. Calculate IHT on this state, assuming no lifetime transfer. What if she had gross chargeable transfer of 147 in 7 years prior to her death? She died on 15 June 2023. Chargeable state is 427, all of which was taken by her brother. So what is the state? 427. What is the nil rate ban? 325. Remember, they have not mentioned about residence. Solely nil rate ban. No gift was made in the first scenario. So it's just 325,000. You deduct from this. This is the amount Death, so 40% tax, this one. Because it was left by her brother, nothing to charity. Death tax is 40%. Okay, it will not reduce to 36. This is very simple. Now assume there's a lifetime transfer. So because there's a lifetime transfer and it was within 7 years, this will be deducted from the nil rate band. So now your nil rate band is 178, not 325, which will be deducted from this. And this is taxable amount and IST is 40%. This is your tax. Okay. Now, that's very easy. Coming to test your understanding 8. Calculate IST on the state and the due date of payment. Two gifts was made, 180 to 28. This is to trust to his cousin. This is pet. This is CLD. And he dies on this date, leaving a gross chargeable value of this much, which is bequeathed to his girlfriend. Okay. So first one is CLT, next one is pet. These are the date of gift. Transfer value is already given. Deduct your annual exemption chargeable amount because this is paid by whom? Thomas. It's net CLT. Okay. So this 320, it will remain 174,000 because no tax will be paid. You see, 325. The nil rate ban is more than this chargeable amount. And no gift was made before that, so taxable amount 0, IST is 0. Next, coming to pet, 222 only will be carried forward. No taxable amount, no IST because pet during lifetime is not chargeable. Okay, this is during lifetime. Now we are coming to the on death. On death. This is the value of death and 7 years before this date. Before the date of death. 23 April 16. So if you see 23 April 16, this gift will be exempt. It's more than 7 years. Only this pet will be chargeable. That is this triple 2,000. So that triple 2,000 only will be chargeable. Nil rate ban at death is 325. Remember, 7 years before this date, he made a gift of 174,000. That is this gift. This falls within 7 years. Just check the dates. So nil rate band will be now 151. Taxable amount is this much. Tax rate is 40% because it is left to girlfriend. And tapper relief will be there because he survived 4 to 5 years. So 40% is the tapper relief. And because it's bad, no IST payable in lifetime, it is 0. This is the IST payable on death. Who will pay it? Cousin. Due date. What is the due date? 6 months from this date. End of this month. That's March. So April, May, June, July, August, September. I'm sorry, it's from the due date of death, not the gift. I'm sorry. So April, May, June, July, August, September, October. That's why 31st October 2023. Same for this 6 months from the due date of death. Who will pay executors? Because this is CLT. This is the state value. The state. The state is on the date of death. What is the cross chargeable amount? They have already given. What is that nil rate ban at death? This much. How much gift they utilized? This gift within 7 years. This much is nil rate ban available. This is the taxable amount. 40% is this much. That's it. Tapper relief and all will not be available on death state, remember. Okay. But for nil rate ban, we need the value of the gift 7 years before. Even on the state value. Now coming to test understanding 9. Calculate the inheritance tax due on Ashley's death state. All these are about death state now. So slowly we are moving to death state. Ashley died on 1st December 2023, leaving a charitable estate of 750, including a residential property. Remember now, we'll see whether this is available or not. A 400. Ashley lived in the property for 10 years before death, and at the death of death had a repayment mortgage of 80,000. Left the residential property to daughter and the residue of her estate to her partner, Ted. Ted have never been married and Ashley made no lifetime gift. Okay, now. So this is the gross chargeable amount. Residence related, first you deduct, then you deduct nil rate ban. This is the taxable amount. Tax is 40%. This is the Ashley's, this one. Now, there is a working to this. Remember, residence nil rate band is lower of the net value of the property. What is the value of the property? 400 was the value of the property. Mortgage was 80,000. So 320. And threshold is 175. So this is lower. So this one. Okay. Now, test your understanding. 10. These are the assets. House. That means you have to calculate the available nil rate band and IST liability on death date. Assuming here he made no lifetime gifts. Bank account 700, quoted share 750, credit card bills 3000, value of estate is this much. Left the house which they live for 1 year to their daughter. The shares to their husband and the residue to the estate to their son. Now coming to test understanding 10. Remember, this value of the estate is more than 2 million. Isn't it? It exists 2 million. So you have to deduct the nil rate band. And remember the date of death. It is on this date, after this date. So he's entitled to this residence nil rate band. Deduct this amount, value of state minus 2 into 50. So your maximum residence nil rate band will reduce by this much. This is the reduced residence nil rate band now. This also you have to calculate. This is the reduced, and what is the net value of the property? Whichever is the lower. This 600,000. Only on this you get the residence nil rate band, not the others. The 600. So this one is lower. Now, remember they told you to calculate IST. So to calculate IST, you need the state value. From here, deduct. See, anything to husband, spouse is exempt legacy. Spouse, there's exemption. We studied all this exemption, all this understanding we studied earlier now comes to this. So anything to husband, that shares that went to husband, 750,000 is written here. You see? They told the shares to their husband. So this quota shares to their husband. Exempt. Then residence nil rate band. First you deduct. Then you deduct nil rate band. Because no lifetime transfer, full 325,000 is the taxable amount. So 40% tax, this one, because you left everything to you didn't leave anything to charity. So it's this much. Now coming to the last question. Test understanding 11. A. No lifetime transfer. B. Made this much to his son on this date and it's a pet. So Dave was widowed on the death of her husband who dies on this date. See, Daria also dies, okay? Because of her death, what is the tax? But then his husband also dies before on this date. Danny had a chargeable state value of this much. And this was left entirely to the wife. State was 50% share of family home. Dad died on this date. State values was this much to her 2 children. Her family home was valued this much. No lifetime transfer, nil rate band was 300 because it was on this date he died. First, remember, Dennis made low lifetime transfer. So on Dennis' death, what happens? First, we'll explain. No lifetime gift. So full residence nil rate ban will be available for his death state. First, we'll talk about the husband's death. Nil rate ban fully available on his death state. Coming to the transfer, he transferred the spouse to Daria, his wife. It's an exempt legacy. That's why no IST was due on his state because it was left his wife, and therefore none of his residence nil rate ban was utilized. That means 100% was fully unutilized. Coming to Daria, when the wife dies, her death state. This is the gross chargeable amount. This is the death rate residence nil rate ban. It is her, and this is from Dennis, taken from the spouse. And then nil rate ban hers and from the spouse. That means from his husband. So this is the taxable amount. 40% is the tax. Done. Who will pay this tax? Executors, because both are dead, but borne by Diane's children. Now, we have some notes to this. See, although the residence nil rate ban was available 300,000 on the husband's death, the amount unused was 100% of this. And this percentage, when you're applying, remember it is to the current residence nil rate ban. This thing you have to know, not to that previous 300. Currently is 325,000. To calculate the amount that can be transferred, this thing keep in mind. Next note. The executor must claim the transferred this on the submission of IST within 2 years from her death or 3 months after from the start of the year letter. It's about the date. Coming to the second one. She is making a lifetime gift to his son. So on her death, what happens? Becomes chargeable. On his death, see, the lifetime gift to his son is a pet. No lifetime IST. But gift becomes chargeable on his death because it is within 7 years. So the pet will be covered by nil rate ban available at death. Therefore, no IST is due. We'll see what is the amount. If it's less than 325, yes, it is 182,700. That's why it will be covered by a nil rate ban. That's why no IST. However, the pet utilizes of his nil rate ban available at death. See, from this amount, lifetime gift. When we are calculating lifetime inheritance tax on pet, remember from this amount we deduct annual exempt amount, 2 annual exempt amount, current and previous, and this is the gross chargeable amount. This gross chargeable amount will be available again, will be used against the nil rate ban at death. That's why we need it. This amount 176,700. Transfer of his estate to Daria is an exempt legacy. When a husband is dying, he's giving it to whom? The wife. It's an exempt. Therefore, after taking account of his lifetime gift, that means this. So this is on Dennis' death. Okay, Dennis' residence nil rate ban is how much? 300. He utilized how much of pet? 176. This is unutilized. So if you see the unutilized portion, we have to find the portion. 123 out of 300. It is 41.1% is unused. We need this portion. On her death, the wife's death. First the husband's death, then the wife's death. Why we need all this? To find this portion. Because we need to apply it to her death, the wife's death. Her chargeable amount is this much. Residence nil rate ban is this much. He'll be having 2 residence nil rate ban. It is her nil rate ban, but when it is transferred from Dennis, only 41.1% of C25 can be transferred. And this is the taxable amount, and it's at 40%. So this is the tax on IST. Now, let us summarize this lecture. IHT payable on the death state. So, the occasions of charge, lifetime gift, could be CLT or PET. CLT, first we compute lifetime IHT because they are always chargeable. So, we pay IHT during lifetime and also on death, additional tax we pay. So, we have to consider exemptions first, like anything, uh, spouse exemption, charity or political party, then any small gift, normal expenditure from income. Then you calculate chargeable amount of the gift which are not exempt. Use diminution in value, that means transfer in value. Value of the gift and value of the asset before, at the date of gift and after the gift. How much the value has been diminished in value or what is the transfer of value. Normally they give you the value, so you don't have to worry about it. Then you consider your marriage exemption and annual exemption. If it's marriage exemption, also you have in the same question, deduct that before deducting annual exemption. Third, calculate lifetime IST at 20 or 25% depending on who is paying. If it's donor, tax is 25% and it's a net gift. If it's donee, tax is 20% and it's a gross gift. Then the nil rate band available during lifetime, 325,000, you have to consider. When we are taking nil rate band, also see whether there are any gifts made 7 years before that gross chargeable lifetime transfer. If there was any gift made, that will be deducted from your residence nil rate band. Sorry, nil rate band. If no gift, usually the first gift that is given, no gift, like during the 7-year accumulation period, you don't have any other gift. So normally you get full 325,000 nil rate band in your first gift. Calculate gross amount to carry forward because you need it for future computation. Like in the death stage and when the donor dies. During that time when we have to pay additional tax, we need that gross amount. Remember the amount has to be gross. If it's net amount, gross it up. How do you gross it up? Whatever the tax you are paying at 25%, add with the net amount. That is the gross amount. Next, PET. This is the second computation we do. But when we have PET, CLT in a chronological order, do it in a chronological order. We have done questions. So, PET during lifetime are exempt, but when donor dies within 7 years from the date of gift, it becomes chargeable. If it's after 7 years, it's exempt. Okay. So calculate the gross chargeable amount of gifts in the 7 years before death and consider fall in value relief. That also we have done. Calculate the tax at 40% because when we are dying, death tax is 40%. After residence nil rate ban available on death and gross CLT and penalty which have become chargeable in the 7-year accumulation period. Calculate and deduct tapper relief. Tapper means if you are dying within 3 to 7 years. If it's more than 7 years, exempt. Less than 3 years, if you are dying, let's say in 2 years you are dying from the date of gift, no tapper relief. If you are dying in 1 year, no tapper relief. It has to be between 3 to 7 years. And the more you stay, the more tapper relief will be more. For example, if you are staying alive 3 to 4 years, if you are dying within 3 to 4 years of the date of gift, tapper relief is 20. Then 4 to 5, 40. 5 to 6, 60. 6 to 7, 80%. Like that. The more you stay alive, the more tapper relief. The less you stay alive, less tapper relief. For CLT, deduct lifetime inheritance tax paid. See, when we are calculating CLT, we pay lifetime inheritance tax. Now we deduct it during death. But for PET, no deduction needs to be made for inheritance tax paid. Because we didn't pay any inheritance. First time we are paying tax for PET is when donor dies. Now the death state. Last computation. Calculate gross chargeable state value. Normally it's given. Here, tax could be at 40 or 36%. Remember, death tax on lifetime gift is always 40%. But if it's a death state, Tax could be 40% or 36% also. 36% if you are leaving the state in the hands of charity. That means if you are leaving at least 10% or more than 10%, then IST is 36%. We'll see that when we do death state in detail. Here also we have two things: normal nil rate ban, addition to that residence nil rate ban. Deduct first residence nil rate ban and then nil rate ban. Here also we have to take account of the 7-year period. Gross CLT and PLT in the 7 year before death. Same way how we have done for the other taxes. Calculate and deduct QSR and DTR, quick succession relief and double taxation relief if applicable. They will be given to you in the question. Okay, we haven't done it yet, but we'll do it later in the later lectures. Now finally the general IHT. So IHT is charged on transfer of value of chargeable property by a chargeable person. Domicile status determines the extent of liability. How domicile status determines CGT and IHT? Whether UK domicile or not, UK resident or not, same way for IHT also. Occasions of charge, lifetime gifts. For lifetime we have some gifts which are exempt. Exempt gifts, no IHT is payable, whether lifetime or on death. If it's pet, no IHT during lifetime, but during death, yes, we pay IHT if you are dying within 7 years of the date of gift. And if you are dying within 7 years, based on the years, we'll calculate deduct tapper relief. CLT, they're always chargeable. Lifetime also, at the date of death also. Okay, the lifetime rates. Lifetime rates are 20 and 25%. Based on who is paying, donor or donee. And if you are dying within 7 years, the donor dies, less the tapper relief, less IHT payable during lifetime. Now, death state. IHT due calculated at death rate, less QCR and DTR. That's it. So, thank you very much for watching this lecture, and I shall see you in the next lecture. Next lecture is the continuation of IHT. And if you haven't watched my previous lectures, that is on income tax and CGT, which I have covered entirely, you can watch my previous lecture under the ATX playlist. And these lectures are applicable till March 2025 exam. And if you want to get my slides, you have to WhatsApp me on my content. My contact number is given. Or you can email me, where I will give you the payment details for the ATX slides. So for more details, you can contact me. And thank you, and I shall see you in the next lecture.